Silver hit 66.31 per ounce. And if you understand what that number means, you should be paying very close attention right now. Because the last time silver broke through a major resistance level like this, it was April 2011. And in the months leading up to that moment, silver went from $17 to $49 in less than a year. That's a 188% gain. But here's what most people don't know about that move. It wasn't random. It wasn't speculation. It was a signal that the entire monetary system was under stress. And that same signal just flashed again. Let me show you exactly what's happening right now, why this is different from anything we've seen in over a decade, and what it means for your wealth in the next 6 to 12 months. Silver has been stuck in a range for years, decades really. It hit $50 in 1980 during the Hunt Brothers saga. Then it crashed. It hit $49 in 2011 during the aftermath of the financial crisis. Then it crashed again. And for the last 14 years, silver has been trying to break through that $50 ceiling. Every time it got close, it got smacked down. Until now. On October 22, 2025, silver broke above $48, then $50, then $54, then $58. And as of today, December 17th, it's trading at 66.31. That's a 55% gain year to date. Gold is up 43% in the same period, but silver is outpacing gold. And when silver outpaces gold, that tells you something very specific is happening in the market. It tells you that industrial demand is surging, that physical shortages are building, and that smart money is positioning for something big. Let me give you some context. In 2011, when silver hit $49, the world was dealing with the aftermath of the 2008 financial crisis. Central banks were printing money. The Fed had launched QE1 and QE2. The European debt crisis was unfolding. Greece was on the verge of default, and investors were fleeing into hard assets. Silver was the play. It was cheap relative to gold. It had industrial demand, and it was in short supply. So it exploded. But then something happened. The CME, the exchange where silver futures trade, raised margin requirements 5 times in 9 days. That means traders had to put up more cash to hold their positions, and when they couldn't, they had to sell. The price collapsed. Silver went from $49 to $26 in a matter of weeks, and it stayed suppressed for over a decade. Now here's what's different this time. The fundamentals are stronger, the supply deficit is worse, and the institutional demand is unprecedented. Let me break that down. First, supply. Silver production peaked in 2016 at around 900 million ounces per year. Since then, it's been declining. We're now producing around 830 million ounces annually. But demand is over 1 billion ounces. That's a 200 million ounce deficit every single year. And that deficit is being filled by above-ground stockpiles. But those stockpiles are running out. The Silver Institute just released their latest report. They're projecting a supply deficit of 215 million ounces in 2025. That's the largest deficit on record, and it's not getting better. Why? Because silver is a byproduct. About 70% of silver comes from mining other metals like copper, lead, and zinc. So when those metals aren't profitable to mine, silver production drops. And right now, with energy costs high and ore grades declining, miners are cutting back. Second, demand. Industrial demand for silver is at an all-time high. Why? Solar panels, electric vehicles, 5G infrastructure, AI data centers. All of these technologies require silver. A single solar panel uses about 20 grams of silver. An electric vehicle uses about 25 to 50 grams. A 5G base station uses even more. And the world is building out these technologies at an unprecedented pace. China alone is installing over 200 gigawatts of solar capacity per year. That's consuming over 150 million ounces of silver annually just for solar. Add in EVs, electronics, and everything else, and you're looking at over 600 million ounces of industrial demand. And that number is growing every year. But here's the kicker. Investment demand is surging too. Silver ETFs have seen record inflows in 2025. The largest silver ETF, SLV, has added over 50 million ounces this year. That's physical silver being pulled off the market and locked up in vaults. And it's not just ETFs. Retail demand is exploding. The U.S. Mint sold over 40 million Silver Eagles in 2024. They're on track to sell even more in 2025. Dealers are reporting premiums of $5 to $8 over spot price. That means people are paying $71 to $74 for a 1-ounce coin when spot is $66. That's a sign of physical shortage. Now, let's talk about what's happening in the futures market, because this is where it gets really interesting. The COMEX, the exchange where silver futures trade, has a problem. They have a lot of paper contracts, but they don't have enough physical silver to back them up. As of the latest data, there are about 400 million ounces of open interest in silver futures, but there are only about 300 million ounces of registered silver in COMEX vaults. That's a 100 million ounce shortfall. What does that mean? It means if everyone who owns a silver futures contract decided to take delivery, the COMEX couldn't deliver. They'd default. Now, most futures traders don't take delivery. They roll their contracts or settle in cash. But some do. And the number of delivery requests has been rising. In November 2025, delivery requests hit a record high. And the COMEX had to scramble to find physical silver to meet those requests. This is what happened in 2011. Delivery requests surged. The COMEX got nervous, and they raised margin requirements to force traders out of the market. But this time, there's a difference. This time, the physical shortage is worse, and the institutional players are bigger. Let me tell you about what's happening with central banks. Because this is the part that most people are missing. Central banks don't buy silver. They buy gold. But they're buying gold at a record pace. In 2024, central banks bought over 1,000 tons of gold. That's the highest level in decades. And they're continuing to buy in 2025. Why? Because they're diversifying away from the dollar. They're preparing for a new monetary system. And when central banks buy gold, it signals that they don't trust fiat currency. But here's the thing. When gold goes up, silver follows. And when silver starts outperforming gold, it means something else is happening. It means the market is pricing in a supply shortage. It means industrial demand is overwhelming supply. And it means investors are starting to realize that silver is undervalued relative to gold. The gold-to-silver ratio is currently around 85 to 1. That means it takes 85 ounces of silver to buy 1 ounce of gold. Historically, that ratio has been much lower. In 2011, it was 31 to 1. In 1980, it was 17 to 1. And if you go back to the 1800s, it was 15 to 1. So at 85 to 1, silver is cheap, very cheap. And as that ratio compresses, silver will outperform gold. We're already seeing that happen. Silver is up 55% this year. Gold is up 43%. That's a 12% outperformance. And if the ratio compresses to 50 to 1, silver would need to double from here. Now, let me talk about what's happening geopolitically, because this is driving a lot of the demand for precious metals. The BRICS nations, Brazil, Russia, India, China, and South Africa, are working on a new currency system. They're tired of being dependent on the dollar. They're tired of U.S. sanctions, and they're building an alternative. Part of that alternative involves gold, and potentially silver. Russia and China have been accumulating gold for years. Russia's central bank holds over 2,300 tons. China's official holdings are around 2,200 tons, but many analysts believe the real number is much higher. And they're not just buying gold. They're encouraging their citizens to buy gold and silver. In China, gold and silver are sold in vending machines. In Russia, the government is promoting precious metals as a way to protect wealth. This is a coordinated effort to move away from the dollar, and it's working. The dollar's share of global reserves has been declining for years. It's now around 58%, down from over 70% 2 decades ago. And as the dollar weakens, gold and silver strengthen. We're seeing that play out right now. The dollar index is down, gold is up, silver is up even more, and this trend is accelerating. Let me give you a specific example of what's happening on the ground. In India, silver demand has exploded. India is the world's largest consumer of silver for jewelry and industrial use. In 2024, India imported over 200 million ounces of silver. That's a 30% increase from the previous year. And in 2025, imports are on track to be even higher. Why? Because the Indian rupee has been weakening against the dollar, and Indians are buying silver as a hedge against currency devaluation. This is happening all over the world, in Turkey, in Argentina, in Egypt, anywhere the local currency is losing value, people are buying silver. Now, here's where this gets personal. If you're sitting on cash right now, you're losing purchasing power. Inflation is still running hot. The official CPI number might say 3%, but if you're buying groceries, paying rent, or filling up your gas tank, you know it's higher. And the Fed is in a bind. They can't raise rates too much because it would crash the economy. But they can't lower rates too much because it would fuel inflation. So they're stuck. And while they're stuck, your dollars are losing value. This is where gold and silver come in. They're not just investments, they're insurance. They're a way to preserve purchasing power when fiat currencies are being debased. And right now, with silver breaking through $66, the market is telling you that the debasement is accelerating. Quick aside here, if you're sitting on $100,000 or more in a retirement account, you might want to look into how a gold IRA works. I put together a free guide that covers how you can get physical gold and silver into your retirement account without triggering taxes or penalties. It's in the description below. It's worth checking out if you're thinking about protecting your retirement savings. All right, back to what's happening with silver. Let's talk about the technical picture, because the charts are screaming right now. Silver just broke through a 14-year resistance level. That's a massive technical signal. When an asset breaks through a multi-decade resistance level, it often leads to a sustained move higher. Why? Because all the traders who were short, betting that silver would stay below $50, are now getting squeezed. They have to cover their positions. And when they cover, they have to buy. That pushes the price higher, which forces more shorts to cover. It's a feedback loop. We saw this in 2011. Silver broke through $30, then $35, then $40, and it didn't stop until it hit $49. And it all happened in a matter of months. Now, I'm not saying silver is going to $49 tomorrow, but the setup is similar. The fundamentals are strong, the technicals are bullish, and the momentum is building. There's another technical indicator that's flashing right now. The 50-day moving average just crossed above the 200-day moving average. That's called a golden cross. And it's one of the most bullish signals in technical analysis. When you see a golden cross on a long-term chart, it often precedes a major move higher. Silver had a golden cross in early 2024, and since then, it's up over 50%. If this pattern continues, we could see silver at $80 or even $100 in the next 12 months. But let's talk about the risks. Because nothing goes up in a straight line. Silver is volatile. It can drop 10% in a day. It can rally 15% the next day. If you're going to invest in silver, you need to be prepared for that volatility. You need to have a long-term perspective. And you need to understand that this is not a get-rich-quick scheme. This is about preserving wealth and positioning for a major shift in the monetary system. There's also the risk of intervention. In 2011, the CME raised margin requirements and killed the rally. Could they do it again? Possibly. But the difference this time is that the physical shortage is worse, and the institutional demand is stronger. If the COMEX tries to suppress the price, it could trigger a run on physical silver, and that would make the situation even worse. There's also the risk of a recession. If the economy crashes, industrial demand for silver could drop. That would put downward pressure on the price. But here's the thing. In a recession, central banks print money. And when they print money, gold and silver go up. So even in a recession scenario, silver could still perform well. It's a hedge against both inflation and deflation. Now let me tell you a story that illustrates what's happening right now. In 2008, during the financial crisis, a small group of investors saw what was coming. They saw the housing bubble. They saw the leverage in the banking system. And they positioned themselves to profit from the collapse. Michael Burry, the guy from The Big Short, was one of them. He bought credit default swaps on subprime mortgages. And when the market crashed, he made billions. Right now, there's a similar group of investors who see what's coming. They see the debt bubble. They see the currency debasement. They see the supply shortage in silver. And they're positioning themselves. They're buying physical silver. They're buying mining stocks. They're buying futures contracts. And when this thing breaks, they're going to make a fortune. But here's the difference. You don't need to be a hedge fund manager to participate. You can buy silver coins. You can buy silver bars. You can buy a silver ETF. You can buy shares in a silver mining company. The opportunity is available to everyone. The question is, are you going to take advantage of it? Let me give you some specific numbers to think about. If silver goes to $80, that's a 21% gain from here. If it goes to $100, that's a 51% gain. If it goes to $150, which is where some analysts think it could go in a real supply squeeze, that's a 127% gain. Now compare that to what you're getting in a savings account, maybe 4% if you're lucky, or what you're getting in the stock market, which is overvalued and due for a correction. Silver offers asymmetric upside. The potential gain is much larger than the potential loss. And here's the thing about silver. It's real. It's tangible. You can hold it in your hand. It's not a promise from a bank. It's not a digital entry on a ledger. It's a physical asset that has been money for thousands of years. And in a world where trust in institutions is eroding, that matters. Let me tell you about what happened in Venezuela. In 2013, Venezuela was one of the richest countries in South America. They had oil, they had resources, but they also had a government that printed money to pay for social programs. And over the next few years, inflation spiraled out of control. By 2018, inflation was over 1 million%. The currency became worthless. People were using wheelbarrows full of cash to buy a loaf of bread. But the people who had gold and silver, they survived. They were able to trade their precious metals for food, for medicine, for passage out of the country. Gold and silver became the real currency. And that's what happens when fiat currencies collapse. Precious metals become the medium of exchange. Now, I'm not saying the US dollar is going to collapse like the Venezuelan bolivar, but I am saying that the dollar is losing value. And the pace of that loss is accelerating. The national debt is over $36 trillion. The deficit is over $2 trillion per year. And there's no plan to fix it. The only way out is to print more money. And when they print more money, your dollars lose value. But silver doesn't. Silver holds its value. And in times of currency debasement, silver goes up. Let's talk about the mining side of this equation. Because if silver is going higher, silver mining stocks are going to explode. In 2011, when silver went from $17 to $49, some silver mining stocks went up 500% or more. Companies like First Majestic Silver, Pan American Silver, and Hecla Mining all had massive runs. And we're seeing the early stages of that again. Silver mining stocks are leveraged plays on the price of silver. If silver goes up 50%, a mining stock might go up 150% or 200%. Why? Because the cost of production is relatively fixed, so when the price of silver goes up, the profit margin expands dramatically. And investors pile into the stocks. But here's the catch. Mining stocks are risky. They're volatile. They can go down just as fast as they go up. And not all mining companies are created equal. Some have good management, some have bad management, some have high-grade deposits, some have low-grade deposits. You need to do your homework. You need to understand the company's balance sheet, their production costs, their reserve base. Or you can invest in a mining ETF that gives you exposure to a basket of companies. There's another angle to this story that most people aren't talking about, and that's the role of silver in the green energy transition. The world is moving away from fossil fuels. Governments are mandating electric vehicles. They're subsidizing solar panels. They're building out wind farms. And all of this requires silver. A single wind turbine uses about 1,000 ounces of silver. A solar farm uses millions of ounces. An electric vehicle uses 25 to 50 grams. And as the world builds out this infrastructure, the demand for silver is going to skyrocket. The Silver Institute estimates that green energy demand for silver will double by 2030. That's an additional 200 million ounces per year. And remember, we're already in a 200 million ounce deficit. So where is that silver going to come from? The answer is, it's going to come from higher prices. When the price of silver goes up, it incentivizes more production. Miners will reopen old mines. They'll explore new deposits. They'll invest in new technology to extract silver more efficiently. But that takes time. It takes years to bring a new mine online. So in the short term, the only way to balance supply and demand is through higher prices. And that's what we're seeing right now. Silver is breaking out because the market is starting to price in this supply shortage. The market is starting to realize that silver is not just a precious metal. It's an industrial metal. It's a critical component of the technologies that are going to define the next decade. And it's in short supply. Let me give you one more story to drive this home. In the 1970s, the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, tried to corner the silver market. They bought hundreds of millions of ounces of physical silver. They bought futures contracts. They drove the price from $6 to $50 in a matter of months. And then the market crashed. The exchanges changed the rules. The Hunts were forced to liquidate, and silver collapsed. But here's the lesson. The Hunt brothers were able to move the market because silver is a small market. The entire above-ground supply of silver is worth maybe $1.5 trillion. That's tiny compared to gold, which is worth over $15 trillion. It's tiny compared to the stock market, which is worth over $50 trillion. So when big money moves into silver, it moves the price a lot. And right now, big money is moving into silver. Institutional investors are buying. Hedge funds are buying. Sovereign wealth funds are buying. And retail investors are buying. The demand is overwhelming the supply. And the price is reflecting that. So what does this mean for you? It means you need to pay attention. It means you need to understand what's happening. And it means you need to make a decision. Are you going to sit on the sidelines and watch? Or are you going to position yourself for what's coming? If you decide to invest in silver, here are a few things to keep in mind. First, buy physical. Coins, bars, whatever you can get your hands on. Store it somewhere safe. Don't leave it in a bank. Banks can fail. Vaults can be confiscated. Keep it where you can access it. Second, consider mining stocks. They offer leverage to the silver price. But do your homework. Invest in quality companies with strong balance sheets. Third, think long-term. Silver is volatile. It's going to go up and down. But if you have a long-term perspective, you'll be fine. And finally, don't put all your eggs in one basket. Silver should be part of a diversified portfolio. You should have stocks, bonds, real estate, and precious metals. But given what's happening right now, given the signal that silver just flashed, you should have more exposure to silver than you did a year ago. Because here's the bottom line. Silver just broke through a level it hasn't seen since 2011. It's up 55% this year. It's outperforming gold. The fundamentals are strong. The technicals are bullish. The supply deficit is the worst on record. Industrial demand is surging. Investment demand is exploding. And the geopolitical backdrop is driving investors into hard assets. This is not a drill. This is not hype. This is a historic moment. And if you understand what's happening, if you position yourself correctly, you could see life-changing returns in the next 12 to 24 months. The signal has been flashed. The question is, are you going to act on it?